Good afternoon, everyone. Thank you for joining in. My name is Baldev Binder, and welcome to our webinar on invoice financing. I'm very pleased today to have an exciting panel with me. We'll start with Mr. Sean Edwards, who is Head of Legal at SMBC Bank in Europe, but also the Chairman of the International Trade and Forfeiting Association. We have Mr. Sugirin, who is Managing Director and Global Head of Open Trade Account at Standard Chartered Bank. And when Mr. Abhay joins in a second, we've lost his video, but we have Abhay Narker. There we go. We've got Mr. Abhay Narker from Coface, who's the Regional Head of Structured Credit and Political Risk. Thank you, gentlemen, for joining the conference today. Let me set the background for the theme that we want to talk about today. So there are many ways to describe what we're talking about today. You can call it factoring, you can call it discounting, receivables financing, payables financing, supply chain financing, or everyone likes to use the term Greensill financing because of what's happened in the last few weeks. All of these terms fall under the general bucket of what I would call invoice financing, where you're using an invoice and financing an invoice to get working capital provided. Now, there are many ways of doing it, and I think there's a bit of background that I'm hoping to get the benefit of the panel to get the panel to give me the benefit of. And if anyone wants to find out more about supply chain financing or invoice financing, I would recommend the ICC's Academy, their program for supply chain financing, which can be found online on their website, to give you a background on anyone interested in the business of supply chain financing. But let's start and jump in straight away. I'm going to start with Sean to give us a bit of background as to how does, you've got invoice financing as an umbrella term, which includes receivable financing on the one hand and payables financing on another. Could you tell us more about it, how it works, what elements of it are recourse and non-recourse, and this idea of it being off the balance sheet?
Yeah, sure, Baldev. Good afternoon, everybody. I guess most people are in Singapore. So, as you quite rightly say, there are a number of ways of sort of looking at or understanding the landscape, and I'll just confuse people, but maybe not, with a little bit of a pointer as to where you might get some more information on what I call, the Tower of Babel problem, which is that we've got this very confusing terminology that across banks can mean the same underlying product, but it's described differently. So a number of the trade associations, including my own ITFA, are members of a forum called the Global Supply Chain Finance Forum. And we produced a few years ago a booklet called The Standard Definitions for Techniques of Supply Chain Finance. And that's available, by the way, you can just Google that. That's available free, through our website, globalsupplychainfinanceforum.org. So where we started there was to say, well, all of this is actually supply chain finance. Some people say supply chain finance is what's commonly called reverse factoring, but we prefer to use that term as a more an umbrella term for covering things like invoice financing, things like forfeiting, which is where my association started, factoring, distributor finance. And even within those definitions, there's a number of ways you can approach this and cut this up. So one of the ways we look at it is to say, is it buyer-centric or supplier-centric? So if we look at Greensill, the traditional piece, of the traditional part of that was very much the buyer-centric, what people often call supply chain finance, or reverse factoring, what we call payables finance within the standard definitions. The other way of looking at it is to say, are you buying a receivable or are you lending against receivables? And I think this is where maybe you're coming from. And it's legally, as you and I know, Baldev, because we're both lawyers, it's a very important it's a very important distinction. The problem with Greensill is that actually they were doing both, but you didn't necessarily know that. Certainly Greensill started out as being a traditional payables finance, because I want to use that term, payables finance provider, where they went to a big buyer, an anchor buyer, they had loads and loads of suppliers, and generally speaking, although there are variations, they bought the they bought the invoice from the supplier, but actually what really counted was getting the irrevocable payment undertaking from the buyer, and commercially the buyer was really the only person who mattered. But that was very much about, about financing a receivable. There are even some structures actually in payables finance where you don't need to buy the receivable, but they're a bit racier. But the point is, there is an invoice, there is a receivable. It's not lending against receivables, and that particular universe also can be secured or unsecured. So the problem, and we'll come to it later, is that Greensill had both, but people didn't know, and this is the infamous category of future receivables. Were they really receivables? How were they presented or represented to the funds? And for example, big impact on potentially on the validity of the insurance that they got, which underpinned the funds. That's why they had to close down. But you mentioned recourse, so there's a huge amount of flexibility. If you look at the definitions, of course, the great thing about selling, getting your receivable off balance sheet, and this is what most of these structures achieve, is you've replaced a receivable with cash, and that's much better from the point of view of the seller of the receivable. It's completely off his balance sheet. Now we mentioned recourse, and that there's different ways of packaging up or representing recourse, defining what that is in a particular case. And it's true that you can sell in sort of what you might think are sort of commercial terms, sell an invoice, but if you keep too much recourse back, you won't get it off balance sheet. And here we're into the realm of sort of IFRS 9 and the various accounting standards. Have you sold all the risk and reward? So sometimes what looks like a sale isn't a sale in accounting terms, because you haven't really got it off balance sheet. You've kept too much of that risk. But generally speaking, most structures that we look at, and certainly with invoice financing, and invoice financing really within the definitions is sort of defined as the selling of individual receivables rather than on a sort of whole portfolio or whole turnover basis, as some of the factors do. So enormous number of different variations. But here, I think what we're talking about is selling, receivables, invoices that we know that are really completely without recourse to the seller.
Which is often, I think, as lawyers, we often get these documents thinking, where parties think it's actually non-recourse, it's been sold, and then we look at it and think, not quite. You're still retaining the risk.
And it isn't just lawyers actually have their word on that. It's also the accountants and the auditors. So that's they've got sometimes very. I'm sure Michael can attest with experiences of his own, but very often the auditors, I find, have very odd views on this.
Michael, let me come to you now. So when we talk about assessing risk comes to invoice financing. Now it's such a broad term, invoice financing, and Sean has said the many different shades of gray in between the black and white. So let's say you've got receivables financing on the left hand and payables financing on the right hand. Now you've got, in my head at least, you've got 4 different types of financing. You've got a single one buyer. You're taking a risk on one buyer. That's a standard conventional supply chain financing. You've got multiple obligors, meaning receivables financing, where you've got many possible buyers, and so the risk is spread across many different buyers. And then you've got portfolio basis, where you lump up a bunch of invoices. It's what's traditionally known as factoring. And then you've got the very sexy securitization. Put the whole lot of it into a financial product, wrap it with a bit of insurance, and off you go. It's a financial product on its own. How, as a bank, how do you go about navigating this minefield of different products, and how do you assess risk for each product?
First, thanks, Paul. And I think Sean really teed that up very nicely in terms of how we're looking at it. Buyer-led, seller-led, thinking from a client's perspective, obviously risk is very different from an invoice finance perspective. But what we are looking at, obviously, is there's an aspect of credit risk that we need to mitigate. There's an aspect of operational risk. There's an aspect of how we look at structuring elements, right? There's an aspect, there's many different risks that we need to mitigate, and definitely technology has been a great friend to us if we use that technology really as a tool to help us to really understand the risk associated with these type of transactions, right? And at the upfront, on the outset, when we look at these type of transactions, right? Let's take the classical sense of a normal bilateral invoice finance program, right? There it is a little bit more straightforward. We look at the underlying counterparty. It's more of a bilateral engagement. Then we look at more of the transactional document that comes to us, and we then look at whether that document is genuine, it's accurate, it's something we can prove independently that the underlying transaction actually exists, right? But then we move that into more of a program, which is, to your point, a lot more complex because you have a lot more data points and you have a lot more counterparties to assess, right? That's when you really need to have a very robust infrastructure to really understand at the outset regards to the due diligence itself. And especially when we look at some of these payable finance programs, we need some very heavy lifting up front in essentially looking at what type of information comes from the back end of the anchor, what type of information flows through, is there proper governance within the anchor itself, within regards to the buyer organization, about how they match invoices against underlying purchase order, transport document, and so forth, before essentially you can process that for financing, right? So there's different stages in terms of that type of program, how you can mitigate risk and essentially use technology. And then you talk about securitization itself. That's a very, very different risk profile altogether. And what we have seen is really early days, you know, in terms of what we've done in the past, looking at information, high level of information, and looking and booking a back end. I think we're still early days in terms of really being able to understand transactional risk there and really using cutting edge technology to really give us real-time views and insights what we're really sitting on, right? But back to you, Bala.
Thank you. That's from the bank's perspective, and I think that sort of shows the difficulties, the many different types of aspects to consider when doing financing. Could I come to Abhay and speak about the insurer's perspective when it comes to looking at the different types of products at play? How much, in particular, the question I have is, there's a bit of a symbiotic relationship between the bank and the insurer. The insurer naturally is leaning on the bank for certain levels of due diligence. And is there a danger of things falling between two stools?
This is a very interesting, we already started a discussion in a very interesting area, I think. Before I begin, I would say, I will agree with every single point which Michael said, 100%, that's all risk has to be done. And what as insurers we do is over and above what they've said. So why I'm stressing this point is our assessment is going to be complementary to all what he said, where they have to assess the supplier, who's the background, what's the performance of the supplier, their past collection track record, their sales ledger, how should I say, validation or sales ledger audit. All these things are very, very important, because what normally happens is people come to an insurer and say, this is a buyer XYZ, can you give me a 100 million line or 20 million line or 10 million line? And we look at, and this is the buyer. Now, the point is, if we don't know the buyer in the context of the seller, then it's very hard for us to do an assessment, okay? Then what happens is, in a single buyer situation, we would insist and try to understand the context of the seller and the buyer. But if it is a portfolio, this is what Sean was mentioning earlier, if it's a portfolio, then we don't know who's the supplier. And then we have to rely on the bank to do all what is being said earlier. And in the context and the background of that, we will take an assessment and do an assessment of the transaction. So basically, as insurers, we focus more on a credit evaluation of the buyer. Sometimes the context of the seller is clear to us. Sometimes the context of the seller is missing. So it's all comes back to the information, the quality of information, the understanding of the underlying transaction we have. The more understanding we have of the transaction, our assessment becomes more and more precise.
Okay.
Back to you.
And does it make a difference? This is for the audience, for the panel. for everyone. Does it make a difference really when one labels it supply chain financing? Does it suddenly add a certain magic to it? Because I watched with great interest in not Netflix, a YouTube video of Greensill's questions from the MP Parliamentary Committee, and it's better than Netflix, that's what I wanted to say. And I was watching it, and it seems to be that some of it was effectively, whether you call it secured or unsecured, but it was lending. It wasn't actually supply chain financing. It was just you attach a label supply chain financing to it. And all of a sudden, it goes through a different prism. If it was unsecured lending or secured lending for that matter, it might have gone through a different way of being assessed. What are your comments on that?
Well,
Yeah,
again,
sorry,
you're asking Sean, right?
Abhay, go ahead.
Abhay,
Go ahead.
look, happy to make a comment on that. But by the way,
Sure.
I'd be very surprised if you have any time to watch Netflix, Baldev. You're such a busy man. But yeah, I mean, the way that was presented. Look, Greensill started very much in the traditional payables finance, or let's call it supply chain finance space, and that was actually still and remained a core part of their business. That was very safe. That was the business that, for example, banks like my own and Michael's got involved in, and that has performed. I mean, there's a few issues now because we're finding that actually Greensill had a sort of hidden servicer role, but generally speaking, that has gone pretty well. So the buyers are paying on time and in full, and there aren't really any issues around that other than some of these operational issues. But I mean, what happens? And you know, if you watch that, the evidence that Lex Greensill gave, you know, he talked a lot about, you know, the security. So you know, big theme there was these future receivables, and really trying to give the impression that these really were real receivables because somehow there was security. And I mean, I think, and we'll have to wait until you know, until the truth of all the evidence has come out. And I say evidence because I'm pretty sure there's going to be a lot of litigation coming out of this. But it's not security in the sense that you might think, or one might, you know, any investor might think, security in the sense of owning that receivable. I think it was a very different kind of security. So yeah, I wouldn't get too hung up on what sort of Lex Greensill said to the Treasury Select Committee until we know the full background facts. But you know, in basic terms, you know, you've got to have that receivable. That's the safest thing you can have. And one of the sad things, you know, the consequences of the Greensill saga is that actually the way you can structure investing into these sorts of receivables through funds has been very heavily impacted, and that's sort of wrong, because if you've done it right, there's no reason why it shouldn't be very safe. In the traditional space that Greensill operated in, actually they had securitized. And that was one of the innovations that they really brought to the market, that they securitized these payment undertakings that I mentioned before. So you buy the receivable, but you also get an irrevocable payment undertaking from the buyer. And they sold those on, you know, through a securitization vehicle, and that's very innovative. That's been, or was innovative at the time they did it, but it's been followed now by a lot of people. But the point is, you've got, you know, a receivable or a payable in the case of buying an IPU. The problem is it's very easy, and you've seen this in Greensill, how you can move from, you know, across this spectrum of a real receivable it's been acknowledged by the buyer to prospective receivables. And even within prospective receivables, there's all sorts of different categories of prospective receivables. Some of these are very, you know, one might call them speculative receivables, because certainly if you read some of the press around what's happened, many of these suppliers or buyers actually you know, had no idea that we're not doing business, and in fact knew very little about the buyer client. So there was a mixture within Greensill of payables and receivables, i.e., you know, supply side assets, if you like, being sold by a seller, i.e., a supplier of goods, and sometimes these are really just future business, and there does seem to be misrepresentation, but we'll have to wait and see. But it's very tempting and very easy to move the goalposts sort of silently from this, very safe, acknowledged buyer payable, which you bought from the seller, to something that is purely speculative, and speculative on what basis? One of the big things that Greensill brought to the market was sort of predictive analytics, AI, to actually predict the level of business. But what's the degree of confidence that algorithm works, and on what basis? And what's the sort of data that's being fed into that? All of that very, very opaque. But that is the temptation, of course, when you're doing that sort of business. So very easy to move from very safe to a little bit less safe, to medium safe, to looking very unsafe, to really purely speculative.
But isn't the fundamental question that you need to assess whether there's been a physical trade? Once you start moving into future receivables, where is the physical trade in that? And I want to, Abhay, you had a what's your view from an insurance perspective? Because many people would think, there's no way you can insure this. There's no way you can insure a future receivable. It's not as crazy as it sounds. But the fundamental question I bring up for the panel, and starting with Abhay, isn't the test always to be that there has to be a physical trade?
Well, I think, Baldev, a couple of points have to be, or comments have to be there. And none of my comments are in the context of Greensill, because I have not studied this case and I'm not a competent legal person to comment on them. But I will make a general comment here on securitization, on the questions which you just asked on the assessment of the future receivables and so on and so forth. Now the point is, you look at a simple trade. Okay, we break down into a very simple transaction. Okay, there's a steel producer who is producing steel, and he's selling the steel flat products to his end customers. Then he's buying iron ore from someone, and then he's flattening it and stuff like that. Okay. Now, if someone came and said to this steel producer that, okay, there is a receivable post-shipment financing, which one can call it factoring with invoices, discounting and whatever. But okay, there's a receivable. After the shipment is done, I will pay you the money, and the buyer will make the payment to me. Okay. And then the bank is coming and discounting it. It's a very elementary transaction. Now, if someone come and said, oh, no, hold on. I don't have money to buy the goods. I forget the post-shipment part. I don't have money to buy the goods. Now, if a bank came and said, okay, I want to give you money. That's a loan. I give it to you. For someone can call it a pre-shipment financing. Someone can call it a trade loan, whatever names you can call it. Inventory financing, hundreds of names can be given. But the point is, there's a money given to this borrower. I use the word borrower. Now, you can flip it around and someone can say, oh, hold on, this is supply chain financing. I am doing a payable financing. This guy is importing iron ore from someone, and I am paying off the supplier. Oh, hold on, there's no supplier, there's no iron ore producer, the mining company. There's a trading company in between, and I'm paying to the supplier, a trader in between. So my point is, the same borrowing, you could convert it into very many fancy names. And each time a name is different, it means different things to different people. It means different things to a insurer. It means different things to a bank. It means the different things to an auditor. It means different things to a regulator. So this is where the confusion comes. One can very easily use the word supply chain financing. It's an umbrella word. The point is, what does this word mean to each one of them? And the problem becomes even more if this word is not understood exactly the same by all the actors in the same transaction. Then there's a real confusion here. So if someone came and said, okay, I'm giving a loan, a simple inventory financing loan, can an insurer cover this? Okay, hold on. Some insurers could cover this. There is nothing wrong to cover a trade loan. Now, out in the room, out of 100 insurers, maybe 10 can cover this, not all 100. But the moment you put a flip to this and say, oh, it's a supply chain financing transaction, it's a trade classification, out of 100, maybe 50 could do it. I'm not commenting here on the quality of the credit. I'm only commenting on the type of product.
And why is that so? Why are insurers more keen or open to insuring a supply chain structure than they would what would otherwise be unsecured lending.
See, okay, if it is a lending, there are many different assessments in play. Okay, if it's a pure lending, then it's a balance sheet. What is the promoter's hold in that? What is the security and so on. There's a whole, how many banks are there? What's the multi bank financing facility there and so on and so forth. You will be paid amongst, you're one of the 100 banks or you're one of the 10 banks and so on and so forth. The moment it's a trade transaction, it will be self-liquidating. And because it's a trade, if there's someone who's sold the goods, the buyer has got to pay. Now, in a factoring transaction, the obligation of a buyer to pay to a supplier doesn't depend on the quality, doesn't depend on anything. Even tomorrow, it can be a bank A or a bank B or a bank C, it doesn't matter. Because the buyer has got to pay to the supplier because he has purchased the goods. And that relation and that assessment is different than a bank lending money to a borrower. That assessment is different than a buyer buying goods from a vendor, and the vendor is a third party. It's a trade. See, there are a whole lot of angles coming into play here. Maybe Michael can add a little bit more precise things from a banker's point of view.
Yeah, look, I mean, first of all, I think just want to go back to Sean's point, right? And your original question, Baladev, SCF, right, in its supply chain finance, in its truest form, is a low-risk product, right? In the way we are trying to define it here as part of payable or reverse factoring, right? You have an anchor, yet you have a single anchor, you have a buyer essentially with their supply chain, right? And if done correctly, and the organization, the industry has come together last year and defining what best practice, what a good industry definition of supply chain finance is, right? There's industry, there's an extension of terms that it's within industry norms. There's no revenue share, that something, there's disclosure, right? There's a lot of parameters that if you follow, then supply chain finance is really low risk because you onboard also both sides of the coin, both buyers as well as suppliers, right? It technically is very secure. The moment you start using it for what it is not meant to be, right? And we've seen it as part of Greensill, right? Where other forms of lending was put into that particular fund, right? Where you look to sort of camouflage and make things a bit more opaque, right? And pushing into more high yield, more deeply distressed credit, then you obviously get into much bigger trouble, right? And similarly to Abhay's point in terms of really understanding what's the underlying. The reason why we're so comfortable with trade, or where we, Abhay's point in terms of being comfortable with trade, is because we have line of sight of the underlying good. It may not be just a good that's moved from an ocean tanker or through a container or through flight, right? It could be a service that's being rendered, right? And especially with new economy, there's information that we can detect when a service, a product was received, delivered, and those are important points then to essentially assess whether we essentially are being made whole on due date or not, right? So those things do not exist in an unsecured loan or lending transactions. Once you lend, the money's out the door, you have no view whether the money is coming back or not. Here in a trade transaction, such as invoice finance, you have a lot more staging points, a lot more visibility, a lot more transparency, which otherwise you do not have.
Okay, so a lender, it wouldn't be remarkable for a lender to do supply chain financing for a future receivable based on the technology should be there in the market, based on an existing 5 years track record between two parties to then predict what the flow of the trade would be, even though it hasn't happened yet. Is that correct, Michael?
I don't think we're quite there yet. We have a number of pilots. We do a number of what we call proof of concepts. I quite don't believe yet we have put together, the technology might be ripe, but the data sets are not quite pulled together, right? What you're talking about, future receivables, to Sean's point, right? Can we really see what's coming? I don't think we have that crystal ball yet. The banks clearly, in my view, don't have it yet, right? We can use this information, lengths of history, strength of the anchor relationship, past performance record on delays, dilutions, short shipments, and all that, as a means to understand how we review the performance risk of particular suppliers. Can we 100% determine at this point? Absolutely not, right? But we are using it today already to help augment our risk decisioning, right? What is the performance score of a supplier when a PO is issued, when an invoice is issued, right? And if you think about it, most banks, most of the information that we have is between what happens at the post-acceptance stage, between an invoice to a payment. We do not have the information that resides below or before that from a value chain perspective, right? That sits within an ERP, that sits within a network, right? And that's something we need to sort of pull together, be able to really understand end to end what is the historical performance of that underlying counterparty. Yeah? And that's where we're heading towards to. Clearly, Baldev, we are heading towards. The technology enables to do that, right? And there's a lot of talk around using DLT technology. There's obviously information using machine learning and being able to use all that tech, but I do not believe you're quite there to be able to predict future receivables with absolute certainty.
It's a great idea. And Sean, I wanted to come to you on this idea of SCF being low risk. And I would go further to say it's not just SCF, but invoice financing as well. Some of the common myth that's circulating in the market would be, number one, would be that invoice financing is itself inherently risky because clearly the supplier isn't able to get funding from other sources. That's why he's relying on his invoices and going selling it to somebody else. So it must be inherently dodgy. That's number one. And number two, supply chain financing, because you concentrate that risk onto one buyer, and there's this perennial debate about the accounting standards as to how that is booked, then the leverage of what that buyer has taken on, that gets masked somewhat, and that may lead to catastrophic collapse.
Yeah, that's right. Well, look, there's a couple of points there. Firstly, I mean, and this is not new, right? This is not a new economy or a new. I mean, for decades, centuries, bankers have been looking at the underlying quality of their customers' business, and depending on the kind of how you structure your finance. So, if you're doing things, and this is actually where technology, and I share Michael's comment that maybe the technology is not there yet, but this is certainly where the new technology can help. Because if you look at traditionally the areas where large volumes, and I think this is the issue as well, where large volumes of receivables were financed. This is traditionally sort of whole turnover factoring, and that's a risky business. It definitely is, and it was riskier in the past because the technology wasn't there to understand really the underlying, really the underlying performance, and that's where you find there's a lot of frauds because given the volume of receivables, it's actually impossible to verify each and every one. And so the Holy Grail, and we're moving there. And I'll just say, but as a sort of parenthetically, we've been talking about, and I mentioned, and Lex Greensill himself mentioned in his evidence the great AI that Greensill had in order to safely predict future receivables. The fact is that actually Greensill, as we know now, has collapsed into administration. But it seems that nobody is buying that technology. So the real technology that underpinned the traditional SCF business, which was provided by a third-party platform. When that third-party platform went away, there was nothing to sell. So there is no doubt there's a lot of work being done here. I think if you platformize a lot of these receivables, then you're going to get better analysis and understanding and line of sight into the underlying receivable. You could do that at an individual level. And, in the standard definitions, invoice financing is geared more towards the sort of the individual, properly due diligence or fully due diligence receivable that you're buying. So quite small numbers. And, you can think then you go from that to, for example, pre-export or prepayment finance, where, you are buying future receivables, if you like, with a degree of recourse. But there's a huge amount of mitigants, legal and otherwise, that have been put in place. Now, that's very difficult to do at a portfolio level. And this is what we need to do. The margins are low in this kind of business. It's very competitive. And so you've got to, if you want to do a high volume business safely, you've really got to start using some of the new technology. And it is getting there. But what it also means is the buyers really getting onto these platforms, the sellers getting onto these platforms. And that's always been traditionally the problem in a lot of supply chain finance. You can have, you mentioned concentration of risk on big buyers. That's good and bad. It's if you're doing a whole portfolio sort of financing, whole portfolio turnover financing, then it probably is bad. If you're doing a couple of receivables, it's probably good because you can really understand what your credit risk is. So moving from that sort of highly structured, highly due diligence end of the spectrum to having the big volumes that we need, because that's also, by the way, where you can finance a lot of SMEs. You do need to have a better line of sight. The technology is there. I mean, and it's coming of age now. So the platforms such as Marco Polo and others, they are enabling this to happen, but it needs people to get onto that platform, use the technology. But there's a huge spectrum there. And if you can't use the technology, or indeed, as is happening in Singapore, where moving towards there, or you're moving towards sort of registries of debt, where it's highly organized, and it's a great initiative. We'll see how it works out in practice, because it might be a little bit onerous, but that's another approach to the problem. But yeah, huge range of ways of doing it. The thing is, what we've done in the past, which was high risk, sort of the high volume, low margin business, which is high risk, and that's the reason why it had to be high volume, because you had to make up some of your losses. For us to do that as banks safely, really, we do need the technology. Greensill probably, has shown the direction of travel, but maybe the technology wasn't there. That's all I'll say.
Some questions are coming through. Thank you, Sean. Some questions are coming through, and I'll ask them. We've got questions. We've got a Q&A towards the end.
Yeah, Baldev, before we move into that question, I'll take up one point which you earlier mentioned on the supply chain, in the sense whether factoring is good or whether reverse factoring is bad or not. See, every product, I think, to me, every product is good or bad. It depends on what is the underlying product. Okay. Fundamentally, if you look at, so there is nothing like a wrong product. It's how it is delivered, how it is executed, and what are the intentions behind it. And I would oversimplify this point by saying that if you have nothing against traders do a lot of value addition in the supply chain, but the moment you have traders coming inside a transaction, it becomes layers, and there are complications and complex situations there. If I told you a simple example that, okay, there is a Unilever, there are distributors of Unilever, and there are 10 or 15 of them. Can you do factoring for this? Possibly, yes. Why not? Because these people are there for a number of years, and you could do it. In the same transaction, if Unilever comes to us and say reverse factoring, these are my 5 vendors who have been with me for a number of years, and it's Unilever who is saying, after my invoice is accepted, can you make a payment to them? No problem. There's no problem on this. As a concept, there's no problem. The problem comes when Unilever is replaced by a steel manufacturer, not so known, and therefore you can have question marks on whether these vendors are genuine or not, whether these distributors are genuine or not. Then you have another more question mark when you have traders coming in between, where a vendor is supplying to a trader who is supplying to a steel company. So you see, the moment there are layers coming inside, then it becomes difficult to assess, and therefore the complications come in.
Let me ask you this question,
Abhay, I just want to add one important point, right? I think was alluding to this, right? It's around client selection, right? Client selection is
absolutely
paramount. I think there's a lot of focus around product and the lack of control, or there's been shortcuts being made and all of that. Then obviously you have a very weak structure or product offering at the end. But at the end of the day, upfront, the client selection is paramount to everything, right? If you don't do the clients, have proper client selection, if you don't do the due diligence upfront, no product is going to protect you, because if there's a wrong client intent, if the intent is to fraud you, then no product is going to save you, right? So I think that's a very, very important to remember, right?
But let
Just
me
to
tell you
come
what I see in my world. And in my world, everyone starts out legit, they start out promising, kosher. And somewhere along the line, someone gets a bit more leverage, a bit more greedy, and then they start dabbling in more and more sophisticated financial wizardry. Abhay, this is the question I wanted to ask to you in particular, because credit insurance is taking a bad beating in the past few weeks. And if you watch the video of Greensill, I think in particular, he puts the blame squarely, I think it's fair to say, on the doors of credit insurers. And the common phrase being used is that it's an umbrella that doesn't open at the time when it needs to open. And the point you mentioned on Unilever, for example, right? And I'm not mentioning, I don't speak of Unilever, but any big MNC. Yes, they have their solid list of suppliers. You are happy with that. It goes on for a few years. But somewhere along the line, of this transactions, it starts to metamorphosize to something different. There are more suppliers coming in. They dabble in a bit more sophisticated, questionable transactions. And all of that, I seem to be close somewhat because there's an insurance wrapper around it. Everyone gets this comfort that there's an insurance wrapper around it. So do we need to dig deep into this basket of goodies?
Well, this is a $1 million question, Baldev. I would, how should I say? I would make one comment, take it as a joke, but it's a bit unfair to insurers who carry all the risk and they get the bad name. That's a bit unfair. Then I would also make a comment, and I will exactly add what Michael was mentioning earlier. I think selection of the client is most important. Okay. And for an insurer, I would go one more step further and say selection of a bank is also very, very important, because we need a bank who actually will select a good customer. They would have due diligence processes in place. They would do their execution very well. And most important, I'm not putting any pun or anything to anyone. They will not pull a faster one on you. So this is most important. I mean, what really happens is in the excitement of doing transactions, people forget these basics, They look at the buyer, they look at the seller, then a new buyer comes in, new seller comes in. So very, very important for us, who is the client, what is the underlying structure, who is the bank. If this is done correctly, I think most transactions will go good. And then coming to your point, look, what happens is, I don't want to comment on what Mr. Greensill has been saying, but the point is exactly what I started earlier, If in a supply chain, all the actors involved, the seller, the buyer, the bank, the investors, the platform, the insurer, and many more players, okay? All of them are putting in some value addition to it and creating a structure, okay? Now, if all the players here have a different understanding of why they are, I would imagine everyone should have a same understanding of why they are all in that transaction. The moment people have a different understanding of why they are in that transaction, it cannot be an elephant story. You close the eyes and of everyone, someone touches the tail and says elephant is like a snake. Someone touches the legs and someone says elephant is like a pillar. It cannot be like this. This game is not a blind game. This game is an open game, full transparency, full disclosures. And then if everyone is very clearly aware of it, I don't think so. You will have these long discussions of 3 hours discussions with MPs explaining why these transactions are like this. The fact is, people now, and you see, I don't want to comment on one particular transaction, but the discussions around where the German bank was, whether these transactions were classified as supply chain transactions or not. So even the regulators have a different view of these transactions. So how could you possibly explain if a loan was given, if money was given to a coal mine in Australia? How do you know it's a supply chain transaction? And as I was mentioning earlier, supply chain means different things to an insurer and a bank. Supply chain by definition is self-liquidating. There's underlying trade. as Michael was saying, there's a clear visibility of the trade, and therefore we know where the money is going and where the money is going to come from. If this is not known, then what do you do?
Understood. Shouldn't the fundamental question be that insurance or not, insured or not, the transaction needs to be able to stand on its own legs? When things hit the fan and they come to me and I look at it, it seems to be that the entire focal point of it was the credit insurance. Without it, it would fall apart. And so in my mind, it's more the cart leading the horse more than the horse leading the cart. It's the wrong way, right? How can banks go about, how can lenders go about, what can lenders do about this in terms of how they assess a transaction? Because the lure, the attraction of credit insurance is there. You cannot deny it. But isn't it always a case of returning back to fundamentals of looking at the transaction? Michael?
Yeah, I think there's always a bit of misconception around trade credit insurance. The moment it says insurance, it feels like it's your car or health or life insurance, right? And when we look at or assess a transaction or a structure, right, the question is, would we essentially lend by ourselves without any insurance, right, to this structure or this counterparty, right? Insurance for us is an aspect of credit relief. Are we able to essentially lift and reduce the concentration risk or the exposure that we have? But on its own, we don't look at it 100% cover and therefore relieve ourselves from the actual obligation or the risk that we enter into, right? So it's very, very important that internally, externally, we need to sort of do a bit of education awareness what trade credit insurance really is, right? And essentially what it does, right? And I think that's being lost a bit in terms of the term insurance.
It's the umbrella that will never close, I think. Maybe that's what it's thought about.
If the umbrella is understood correctly, it works very, very well. The problem is it is misused. If you misuse umbrella and you use it as like a gun to pull a faster one on your or to cheat your investor, that's a problem.
Yeah, I think if we push the analogy, I think it's the umbrella that protects you against the rain, but it doesn't protect you against incoming artillery fire. And I think it's because that's not what it's designed for. And I just moving from my ITFA role to my SMBC role, totally endorse what Michael has just said. So we use a lot of credit insurance, and the philosophy or the ethos is always consider yourself as being uninsured when you approach the insurer. What's really good and what credit insurance has really done in the market is it's been a multiplier, a force multiplier, balance sheet multiplier, because you can do a lot more business with the same clients, and so it's a really important product. But I think maybe we're being a little bit pessimistic about how actually trade credit insurance will come out of the Greensill story, because in my view, that there are very particular facts in relation to Greensill's own policy, including the way it was underwritten. But I think in relation certainly to the existing receivables, unless there's been fraud and it's been misdescribed, then they should be paying. They operate on a risks attaching basis. So the fact that that these policies have terminated shouldn't make any difference, provided there's no fraud. And you wouldn't expect an insurer to pay if there was fraud, unless that's specifically what the policy was covering. There are some policies that will cover you, a lot of policies that cover you for fraud, but not your own fraud. And I think that's the real problem here. It's true that the withdrawal of the credit insurance was the reason that Greensill collapsed, but the reason for that is because it was one of the it was the most important underlying condition of the trade funds that Greensill had set up with the likes of Credit Suisse, that they had to be insured. So the moment the insurance dropped away because they couldn't renew it for reasons peculiar to them, and you can see what Lex Greensill himself says about that, about the reason why it was withdrawn, that the funds had to close. But that is just that's not because the trade credit insurance doesn't work. It's because it didn't exist anymore on its own terms. And so it's being really unfairly blamed and tarnished by this, by what's happened in Greensill. It's got nothing to do with the quality of the underlying product. Within ITFA, we've been very vocal about this. We have a very active insurance committee with insurers, underwriters, and bank users. And we're very clear. It's a very important product for trade finance. It's a real partner. One of the things, maybe a little bit of a digression, but one of the things that might happen, and Greensill himself said this, is maybe, and already the regulators in the UK have already been looking at regulating insurance a bit more. It may be that we'll get a bit more regulation in the insurance space, but that doesn't mean that the underlying product is wrong. You just have to look, as you say, it's a fundamental point. What are the terms of the policy? What does it cover? But don't take away from Greensill, please, that trade credit insurance doesn't work. That it's the umbrella that doesn't open when it rains.
I absolutely echo that view, and I'm sure Abhay does as well.
Yeah.
Whenever you mention the word "had to be insured" as a transaction or product, then I start getting worried already. If a transaction had to be insured, it starts raising alarm bells for me. We've got questions from the audience, and I want to take them in the next 10 minutes before we wrap up. And one of it is always the million-dollar question, open to the panelists. In invoice discounting, how do you know the same invoice is not being discounted by multiple financial institutions?
I think Sean mentioned one in Singapore. There's an interesting initiative that's going on because of the big H that has happened last year, right? The Trade Finance Registry that's being launched. I think that's a very interesting initiative itself. We've seen some other sort of industry exchanges in India and other places that are sort of forming. I think what's ultimately interesting is how these exchanges come together, because what's required, especially when we talk about cross-border trade, it's not just for domestic trade, it's cross-border trade that is sometimes a bit open for fraud or duplicate invoice finance, right? And I think at the domestic level, that can be much more sort of governed, but what we definitely need to see is some of these, probably at the central bank level, that there's a bit of more cooperation around how duplicate invoice financing is detected earlier in the cycle, right?
Yeah, it's a really important point about registries, because they are, in principle, a very good idea. And I've seen a couple of private initiatives here. The problem is in getting sufficient data into them, because obviously the amount of invoices generated globally must be the tens of billions, if not trillions. Who knows? It's an almost infinite number. So would you ever have like one solution in a utopia is you have a global registry of all invoices? That's just not going to happen in the real world. So how do you do it short of that? I think we sort of goes back to some of the points that we've made. Clearly, the best type of receivable you get is one that's been approved by the buyer. That's payables finance in its sort of traditional form. Getting more visibility of line of sight through technology is another way, but it's a problem that's going to happen. That's going to be. I think it's going to be with us for a long time, because there's not only double financing, there's fake invoices as well, and the big H in Singapore had plenty of examples of that as well. So it's a really tough nut to crack at a sort of at an industry level. At an individual level, it comes back to what we've been saying. Client selection, knowing your clients, doing the right due diligence. Hopefully soon, being able to rely on technology. There's a number of marketplace platforms where buyers and sellers, the seller of the receivable, the supplier, he's known. There's input, and there can be buyer approvals as well. There's a lot of it's an old problem. There's a lot of exciting possibilities or new opportunities now for solving that.
But it's not just a one-off. It's not just a one-off onboarding due diligence exercise you do, because as I mentioned, there's always that danger of tipping over into a different type of financing down the road. Right. And so it's a constant due diligence that's being done, and that must impact the cost of funding for the banks. And that, wouldn't you say that means that ultimately the cost of funding has to go up?
Firstly, the riskier a deal is, or the riskier a relationship is, the more you're going to charge for it. I mean, that's a given.
Absolutely.
I think what you're saying is, can you really monitor or guarantee that relationship doesn't become riskier? And we've seen in Greensill the temptation to move from very traditional approved payables to prospective to speculative receivables, without there being really any real, it seems, enough transparency. I mean, we'll have to wait and see, but there doesn't seem to be enough transparency about that. So how do you solve that? Well, it can be doing, depending on the kind of business you have, it can be doing due diligence on each underlying trade. And of course, to some extent, banks have to do that already because of a KYC AML requirements, sanctions checking. So you do have to look at each individual deal. I think, and I get another bit of a sidebar, but the problem there sometimes could be you find out too much information. And this always, if you peel off the onion, eventually you're going to start crying somewhere because there's some problem somewhere. There's somebody, who's a UBO of a subsidiary of buyer, or a subsidiary of the buyer, and he turns out to be Mr. V. Putin or something like that. These sorts of that is part of the problem there. But it is very much about doing. It's not sexy. It's very much about doing the due diligence or accepting a degree of risk. And then I would agree. If you find that your client who's been turning over 10 million is suddenly turning over 300 million, well, for KYC AML, you've really got to know why. If it's because he's managed to unearth a whole new universe of buyers for his product, then the question for you as a banker is, what's the credit risk that I'm taking on these? Do I need to revise my terms unless I can get some real visibility into the risk I'm taking? So yeah, it's a constant sort of push and pull with the clients, but the answer is knowing your client. You have to do it to some extent, but we can do that better now.
Understood. Michael, I have a question for you, which I then have a follow-on question for Abhay. And the question is the underlying problem that the banks are not involved in the underlying transaction and only know what they're told by the seller?
Sorry, you just broke up for me, all of that.
The question that was put forward by one of the members of the audience is that the problem is that the banks are not involved in the underlying transaction and they only know what's being told of the seller.
That's age-old, also a bit of age-old question, yes. So what we do, obviously, we do our independent verification up front. When it comes to receivables transaction, we do our due diligence in terms of the quality of receivables, right? We do at point check ledgers if there's an actual receivable available, right? But then as part of the transaction itself, we do check, is there a goods movement, right? We verify transport information that comes with it. And then post-transaction, there is an aspect about post due diligence as well, right? Taking sample transaction information and check whether there are red flags that we can identify. So those are some basic checks. What we've seen is when you don't do these basic checks, and we don't look at these red flags and close your eyes and say, oh, everything is kosher, and you just rely on the counterparty, what they tell you, then you do have a problem, right? But if you do some of these basic checks up front, during the life cycle and post, then you at least have a bit more comfort and can probably sleep better at night.
Thank you. Abhay, the same question, but from your perspective, there's a reliance on what, naturally, you are taking a credit risk on the buyer, you're taking a view on that. But when it comes to the transaction flow, there are limitations to how much an insurer can possibly know, because you are dependent on the bank or the lender to do the necessary due diligence on that regard. So maybe you can wrap up the session with your views on that.
I think this again, as Michael was saying, I fully agree with him. It's an age-old question, because ultimately, when we are covering a transaction, a seeding risk, which means the supplier able to perform, the supplier able to deliver the goods, supplier able to raise an invoice, which is correct invoice with no mercantile disputes, is something which is, if there's a clean transaction, it can be paid. But the point here is we are not having any access to any transaction. So we have to rely on the bank. This is why I keep repeating it. For us, a bank which is very, very important, who's doing all these, what Michael was saying. And if for some reasons, if the bank is kosher about it and doesn't want to look at the transactions, that's where the problems would start, because then they would think that because insurance is there, they don't need to look at many things. And we think that the bank is looking at everything. And this is where the problems would start. The point is, if each, and I keep coming at the same point, if each actor is going to play their part of their role to what they are supposed to do and they ought to do, then there's no problem.
Yes.
We are the players, and then therefore, and again, coming at the same point, if a transaction is a clean transaction, if a bank is doing a uncommitted facility, it's a transaction banking deal, which means your payment of the first invoice need not be contingent upon a supply for the second invoice, which means there need not be a continuity. The bank is having an uncommitted facility, which means if invoice number 1 is financed, if the invoice number 2 is not financed or not covered by insurer, does not mean anything. The buyer ought to have, or the buyer is supposed to make a payment to the supplier for the invoice number 1. And that's why another point which I was making is on the pulling of the umbrella. There's nothing called umbrella for perpetuity. If we feel today the transaction which was shown to us is a good transaction, we want to cover it for a price, the risk is acceptable, we do it. That is nothing to do with I would do the same transaction and I give in writing for next 20 years I will do the same transaction. No, not necessary. The things could change, the conditions could change, and therefore we could change the transaction conditions. So, you know, there are a whole lot of things, Baldev, we can go on for next 2 hours discussing these subjects.
We can, and I'm afraid that we've run out of time. We've reached our 1 hour, and as expected, I think there's still a lot more to be said, but I guess that will be for a different time. I want to thank our panelists. Thank you very much for that very engaging session over the past hour. And for the audience, please feel free. I know there are a few questions that I've not answered, but please feel free to email me the questions. We're happy to provide our comments on it. My closing remarks would be that, once again, supply chain it's not going away. It is the business of the future. It is one to watch, and how we go about doing it is an important exercise. For those that are new to this industry, I want to repeat once again that the ICC Academy, who has kindly helped co-sponsor this event as well, has got a supply chain financing course for those that are new to the industry itself. Everyone, thank you for your time today. It's been a pleasure. Thank you, and we will see you soon. Take care. Bye-bye.
Yes.
Thank you.